So we're doing E9-63B, prepare a performance report at different organizational levels. So we've got I Hear You is a Halifax company that sells cell phones and tablets on the web. I Hear You has assistant managers for the digital and video cell phones. So just one second. I'm going to move this down for a second. There we go. So they have an assistant manager for the digital, and they have assistant manager for the cell phones. These assistant managers report to the manager of total cell phone product line. So then there's actually a manager for the total cell phone product line who, with the manager of the tablet, so now there's a manager over here from the tablets, they report in to Mary Burton. So now Mary Burton is the manager of all sales for all handheld devices. So Burton received the following for November operations. We see cell phone, digital, video, tablets. We see revenues budgeted. We see expenses budgeted. Then we see revenues actual, and we see expenses actual. And I'm going to change these into dollars so that we're all clear. Required. Arrange the data in the performance reports. Show November results in thousands of dollars. Actually, I'm not going to do thousands of dollars. I think it's a little confusing when I do that. So I'm just going to do it in dollars. For the digital cell phones, so digital cell phones, for the total cell phone product line for this manager, and then for all handheld devices. So right here. These are the three performance reports that I'm going to do. Should management investigate the performance of digital cell phone operations? Why or why not? In an exam, when there's more than one required in a paragraph, what sometimes happens is you miss one of the required. So I'm going to put this in red and highlight it so that we don't forget this as a required. So we're going to do a performance report over here. Now I'm going to start with the lowest level, and the lowest level is the assistant manager. So over here, I'm going to do the company name. So it's I Hear You. And then I'm going to say it's responsibility accounting performance report. Okay. And I'm going to say that it is for digital cell phones. All right. And I'm going to say that this is the assistant manager. Okay. Oh, and we should say for November. And I'm going to do 2000XX. Okay. So now what I want to do here is I want to look at the actual, I want to look at the budget, and I want to look at the variance. In the variance, I'm going to indicate favorable or unfavorable, but I'm actually going to do this over here, right here. So unfavorable, well, I'll start with favorable, favorable slash unfavorable. I'm going to put that as its own area because I think it's a little clearer and I can calculate the numbers easier. So I'm always going to start with the calculation for operating income, but I need the revenues and expenses. So I've got the revenues. I'm going to move it over just a little. There we go. I want the actuals first. And because I'm doing this, it won't let me do this. That's very annoying. All right. Because I'm doing this for the assistant manager, I'm going to start with the revenues of actual. So actual revenues right here. And technically, I shouldn't carry this forward. I just should say revenues, but oh, okay, fine. I'll do that. Revenues. Okay, actual revenues are coming from over here, 217,000 digital. And then I want the actual expenses. And that is 134,000. And I'm actually going to put the expenses in as negative. There we go. This will then be the operating income, short form. And I'm just going to add these two numbers together. And I'm going to put this as an underline. There we go. Nice and pretty. I now want the budgeted information. So I've got revenues budgeted for digital, 205. I'm going to put the expenses in as negative, 144. And I'm calculating the total. There we go, 61,000. Now I want to know the variance. So I'm going to take the budget and I'm going to subtract the actual. Students try to memorize that a negative means that it's positive for the company and or a negative means it's negative for the company. I don't want you to do that. I want you to look at the information we have here. This is what the company expected. This is what the assistant manager actually did. Is this good or bad for the company? If it's good for the company, then it's going to be favorable. If it's bad for the company, it's going to be unfavorable. And we see immediately he or she should have sold 205. They sold 217. Yay for us. This is definitely favorable. We are very happy with this particular assistant manager because they increased their sales. I'm going to do the same thing here. I'm going to calculate it the exact same thing. I'm going to take the budget, subtract the actual. I see it's a negative number. Don't care. Now, they should have spent 144,000 and they spent 134,000. Are we happy or unhappy? We want revenues to go up and we want expenses to be lower. So in this case, we are very happy. It is favorable. When both of the variances move in the same direction, it means that we are happy about this outcome. So since these are both favorable, I know automatically that this is going to be favorable too. I can calculate it in the exact same way that I calculated this. So this is negative 22,000. Negative means nothing. It is favorable. We are super happy with what is going on right now for this particular assistant manager. Now, it said we now want the information from the manager. At that level, we're going to not combine. What word am I looking for? Condense. We're going to condense the report for this level. So over here, I've got, I hear you, responsibility accounting performance report. This is not the digital cell phones. This is cell phones. This is for the manager. And of course, it's for November 2000 X1. All right. So now looking for this manager level, right, for all cell phones, we're going to look only at the operating income. And we're going to just carry down. Now, first of all, I need the actual budget variance. So we're going to carry that down and I'm going to copy it. Didn't let me copy it. Just a minute. There we go. Copying it right down here. All right. Now, what I'm going to look at here is I'm only going to look at operating income. So I'm going to look at the digital cell phone operating income. I'm going to take the actual, I'm just going to steal it from the report that I already created for the assistant manager. I don't need to do any calculations. It's all here. But I also need the video cell phones operating income. So here I'm going to calculate it. Now, usually I would have already created a responsibility accounting performance report for the assistant manager for video. We're skipping that step. So I have to calculate this myself. Operating income is going to be the actual revenues minus the actual expenses, 465,000. Budget is going to be the budgeted revenues minus the budgeted expenses. It's going to be 375,000. I'm going to do the usual budget minus the actual, and this is 90,000. Now, they should have had operating income of 375,000 and they had operating income of 465,000. Do we go, yay, or do we slap somebody's face? And in this case, we're going to go, yay, and we're going to say this is favorable. I want the total operating income. So I'm, of course, going to add both of these together, and I'm going to add them all the way across. And I'm going to put a line underneath here because it looks pretty. And so here we go. There we go. Since these two are favorable, I know automatically this is going to be favorable also. So for the manager of the whole cell phone division, we can see that overall they have a favorable outcome. They were only supposed to, well, they had budgeted for 436,000 and they ended up with 548,000. We're all very happy. Now we're going to do Mary Burton. Mary Burton is all cell phones plus the tablets. So I'm going to go down here. I'm going to steal the company name, responsibility accounting report. This is for all handheld devices. It's for Mary Burton, and it's for November 2000XX. Awesome. Again, I'm going to steal the actual, the variance, favorable and unfavorable. I'm just going to plump it in here. And now what I need is I need the cell phone operating income. Well, I already have that. I got it from the managers, so I just can pull it down. Now I want, of course, the tablet operating income. I don't have that. Normally, I would have created a performance report for this manager of the tablets, but I didn't. So I'm just going to calculate it. For actual, I'm going to take the actual revenues, subtract the actual expenses. For budget, I'm going to take the budgeted revenue, subtract the budgeted expenses. And now I'm going to do my usual budget minus the actual. That is 32,000. Favorable or unfavorable? Well, this division was supposed to sell. Well, this division was supposed to have operating income of 72,000. They only had operating income of 40,000. This is definitely unfavorable. To calculate the total operating income, I'm simply going to add these two together, right? Just like I have before. Now, how do I know whether this is favorable or unfavorable? Well, I can see that the favorable is 112 and the unfavorable is only 32. So I know this is going to result overall in a favorable outcome. Why? Because the favorable outweighs the unfavorable. So here I have all of my responsibility accounting performance reports for all these different levels. Now, again, missed the assistant manager, and the manager usually would have that. What is the problem over here? Right? What is the problem with this performance report? Well, when I look at the tablets, I cannot tell whether the revenues declined and the expenses increased, or did the revenues stay the same and the expenses increased, or like, I don't know what has caused this unfavorable outcome. I'm in the dark about how it happened, right? When we do performance reports at this high a level, it doesn't give us the nuances, the nitty gritty. It doesn't tell us how this is happening. And that's a problem with this level of performance report, right? Because I don't know if this was caused by a price change. Was this caused by decreasing cost of goods sold? I am in the dark. I know it's favorable, but I don't know why it's favorable. And that's a problem. Now, up here, remember, it said, should management investigate the performance of the digital cell phone operations? Why or why not? So over here, digital cell phone operations, we can see this is favorable, favorable, and favorable. So you say to yourself, well, wait a minute, it's good. Like we should be patting this person on the back. Why would we want to investigate this? Well, because it's unusual. If I take the variance and divide it by the budget, it'll tell me how much the actual is different than the budget. And we see right away, it came up as dollars. It's not, it's a percentage. We see right away that and don't forget, you ignore the positive or negative sign. We don't give a crap about positive or negative. We're just talking about the number itself, 6%. So we can see that the actual revenues are 6% higher than the budgeted revenues. If I do the same calculation for the expenses, we can see that the actual expenses are $10,000 lower than the budgeted expenses, 7% lower. That's so unusual. Usually, when sales increase, costs increase. So if I increase the volume of my sales, then you expect that the cost will increase by an equal amount, right? I mean, if I increase my sales by 10%, I should see some kind of increase in my expenses. And here I'm not seeing any increase. In fact, I'm seeing a reduction, which is greater than the increase in the revenues. That is very unusual. So when they say, should we investigate the performance of the digital cell phone operations, we should say yes, investigate. The sales have increased by 6%. So it would be normal to see an increase, and I'm just going to move it over so you can see. It would be normal to see an increase in the expenses that are close to the increase in sales. However, expenses have decreased by 7%, which is very unusual. Therefore, these variances should be investigated. Now, not only is it unusual what happened, but these numbers are pretty high. 6% and 7%. Maybe if I saw a 1% increase in the sales and I saw a 1.5% decrease in the expenses, I would say, okay, no problem. But that's not what I'm seeing, right? Those kind of percentages. Now let's look down here and we see what kind of percentages we see here. Here we see 36 and 24%. Holy, I am so concerned about what's going on here, right? Over here, I see a 26 and a 40. I have so many concerns right now. Like, what is going on in each of these divisions? So, performance reports help us to decide who we're going to look at a little bit closer. And if we see something favorable, it doesn't mean we give them a pass. It means I look at the favorable and I say, does the favorable make sense? And if I say it doesn't make sense at all, then I'm going to investigate them, even if they are favorable. All right? Because this assistant manager could be overstating his sales and ignoring the expenses that go along with those sales. They could be understating their expenses. So the sales make sense and we can track that, but they've moved some of their expenses from the income statement as an expense onto the balance sheet as a prepaid expense. I don't know what they're doing, but there's a lot of questions that need to be asked. All right. And that's the benefit of performance reports.